Jerome Booth, Head of Research of Ashmore Investment Management, joins us on the show right now. Jerome, very good to have you on the show. Begin by giving us your sense about India. You've been bullish on the market. As someone watching the market from outside, what do you make of all the noise, whether it's at the economic level or the political level right now for the market? Does it alter your view in any way?
Well, one's views change, over time. There's no big change in view, but what I can observe today is that we have, obviously, the RBI not cutting rates the last meeting. I think that's the correct decision for a number of reasons. We're in a cycle where we've got a lot of people, domestically in particular, worried about a negative cycle and worried that, that policymakers are behind the curve. And I think, pausing on interest rates, despite the weak growth, is good to get us back into a more positive dynamic, whereby we see the central bank really focusing first and foremost on inflation. The drop in oil price helps that scenario for inflation, but I think also the central bank is, I suppose, rather like the ECB in Europe, giving a signal to the fiscal authorities that they need to do more. We need to see some of these subsidies cut. We need to see some structural reform, and hopefully we're going to get some of that. I mean, obviously the potential movement in cabinet posts, is very interesting as well.
Central bank action in India has been conservative and the RBI has left rates unchanged. Do you favour such a decision? What's your outlook on growth and inflation in FY13 and FY14 for the country?
Well, there are lots of potential paths here, so I don't have really hard numbers to give you because it's really, very difficult to predict the future, as you probably realise. And I would think that the key issue here is getting credibility back on, a virtuous circle, if you like, of growth really starting again once entrepreneurs are confident that inflation is under control. And I think that's likely to be assisted if we get, big changes in the government. Obviously, we've got the potential change at the Finance Ministry post. If, say, the Prime Minister Singh takes a more active role there, and if we have, say, a bunch of younger technocrats, really eager to push some structural reform, I think markets would be very, very glad to see that. And that combined with credibility on fighting inflation from the RBI, could lead us to a much more positive dynamic. And in terms of numbers, obviously growth in India is quite achievable at levels of 6, 7 and higher. It does require, as I said at the moment, some action from the government though.
Jerome, what's the view on the rupee? I'm not asking about tomorrow or day after, but how do you tie in the falling currency and falling crude with reduction in trade and current account deficit for India?
Well, I think we've spoken about the current account deficit before. I know there are a lot of people focused on that, but I personally take the view that India should have a current account deficit. If you have, relatively scarce capital, you need to import it. India has huge potential growth ahead of it, and it's quite appropriate that it should have a current account deficit, and it needn't worry about it because it does have very large reserves. So I'm less worried about that. I think the reserves mean that the central bank should probably be a bit more active at managing overshooting in the currency, not trying to drive it any particular direction. And the overall direction of the currency, I think, will likely move in line with growth expectations, as in fact I think the equity market will. So probably we're not there yet, but sometime over the next couple of quarters, depending on government policy and better credibility, I suppose, on inflation, I would expect to see the rupee start to rise again.
All right, fair enough. So between 3 to 6 months, you see a reversal there. What about global risk? Post-Greece elections, what's your view on global risk and how it may pan out?
Well, everybody's risk is different, and of course risk is a complex thing, and volatility is a proxy for it, and a fairly poor proxy in some senses. So but a lot of people think of risk in a sort of absolute and very simplistic way, and of course it's very complex. My risk is different to your risk, partly as a result of information differences, but also due to liabilities being different. And I think what's going on is people, are not seeing more or less risk on a day-to-day basis. They may think that way, but actually what's happening is people's reassessment of risk is going on, and prejudices are being challenged. Anything, for example, called risk-free, that's a signal that the risk which does exist in all assets is not priced. That's a danger signal. And I think what's happening in Greece is, more of the same, unfortunately. I don't think the election really changed a great deal. We do have the potential for some, important decisions in Europe, but of course they may not happen. They may be no more than the sort of behind the curve sort of pace of decisions we've seen already. But I think what is happening, what is structural, is people are realizing that if you've got the bulk of your assets in the HIDIC countries, you are taking a gamble. And it is not true to say that investing in Europe or the United States is somehow safe, or safer even than emerging markets. So people have got to reassess their asset allocation globally, and I think that's a very gradual process.